It's Forex Focus, brought to you by IG, taking a look at an interesting day in Forex markets when you wouldn't quite expect it on this Tuesday, reacting to PMI data, traditionally a mid-tier data release, but having kind of an outsized effect on US dollar and Treasury yields after coming in softer than expected. Let's take a look at what happened exactly. Now, this PMI is the Purchasing Managers Index, and what that does is it's reported by S&P Global, and they give metrics on manufacturing and services, and that both of those private sectors are combined into this composite PMI that you're seeing here. And this is kind of a gauge on expansionary versus contractionary outlook for the economy here, looking at the US, and that threshold is right at that 50 handle. And so we're seeing a 4-month low in composite PMI at 50.9, but composite, manufacturing, and services all came in lower than expected. Manufacturing actually dipping below that 50 threshold into contractionary territory at 49.9. And this is also our first snapshot of the U.S. economy for April, as this is a flash reading while we're still in April for this month's performance. And how did that play out? First, in Treasury yields across the curve, yields lowering off of this data release. Here we have the 10-year Treasury, the benchmark for a lot of consumer rates, that was at year-to-date highs dating all the way back to October last year. Only last week at above 4.7%, taking a dip. I think it was around 7 basis points immediately after the release, below 4.6%. And this has been so interesting to keep track of this year, as it really has been this U.S. data that's driving these yields higher and interest rates higher. Could this be the start of a reversal? Who knows, but we really haven't seen many down days in a row for these Treasury yields. Another market that we saw have a great effect was this U.S. dollar weakening across the board against all these major currencies. After such strength in recent weeks and months, we have euro dollar back to 107, trading around there all day. We had the Aussie dollar coming back towards that 65-cent handle, and against the Canadian dollar back below 137 for the first time in a while. And so this has been really interesting, again, like Treasury yields, that this US dollar has been boosted so much on relative strength as all these other global economies are starting to slow down, especially in the euro area, and further abroad as it relates to the Middle East as well. But the US has been outperforming, so even the slightest tinge from this mid-tier PMI sending this US dollar backwards, weakening against major pairs. But the big winner today has been this British pound, and for a couple reasons this pair has been really interesting to watch the past few days. Today back above 124, and that comes after a series of moves. The UK also reporting PMI data, composite stronger than expected, which you can see there early morning. I think it was around 3 or 4 a.m. Eastern time, caused this pair to shoot up initially, and then that big green candle near the right of the graph off of the US softer PMI data. But when we're looking over the past few days, you're seeing, this is an hourly chart here, we're seeing all the way back to Friday that this pair's just gotten back to where it was last week. And what's interesting about that big move downward, we actually hit a new year-to-date low on Friday, on Monday, yesterday, right below 123, and those moves compounding from Friday, coming off of a lot of dovish Bank of England comments from officials like Governor Bailey, as they now expect inflation to be under control, causing the US dollar to appreciate against the pound. Now all of that coming back as maybe this is the first signal of our inflation here in the US coming under control and our economy starting to slow down. But really what US traders are looking for is what this means for the Fed, when the Fed will decide to cut interest rates. Because in Europe, it's looking like for the ECB, it'll be around June, and given Governor Bailey's recent comments in the UK, the Bank of England may match the European Central Bank in cutting in June. But the story in the US has been different all year. Coming at the start of the year, if you've been tracking this market, then you know that we were initially looking these futures prices from the CME coming together to calculate these probabilities for us with the CME FedWatch tool. If you've been watching this, then you know these traders have been pricing in 6 or 7 25 basis point rate cuts at the beginning of 2024, but constant U.S. growth, strong U.S. metrics from employment, from inflation, and PMIs in the past have pushed these rate cuts out, as we've now looking more towards 2 or 3 25 basis point cuts by the end of the year. Now we're looking at possibly July for the first interest rate cut of the year, of the cycle. Now nearing 50-50, still not above 50%, as September looking like the more likely. But now this percentage has grown in the past day around 5% in favor of a rate cut. So it'll be interesting to see if more U.S. data starts to turn around. Particularly excited for later in the week on Thursday, the first glance at U.S. 2024 quarter one GDP. If for whatever reason that starts to turn around, then maybe these interest rate cut probabilities start getting priced back in for these summer months, and then who knows for towards the end of the year if that translates to more than 2 cuts, more than 3 cuts, and interesting to see what Fed Chair Powell will have to say at this May meeting. But we'll see where it goes from here, what U.S. data will tell us for the month of April, if it'll continue to tell us what this PMI had told us about maybe a slight slowdown, or if this is just a hiccup along the way of a continued U.S. strong economy. Thanks for watching.